Hi everyone, I'm America Josh, and welcome to our monthly expert series where we find experts in a wide range of fields to make your life in the US just a little bit easier. America Josh is a community of over 75,000 Australians across the United States, and we hope with every one of these episodes that you can walk away feeling informed and like a little better connected. Tonight, we have federal budget and end of financial year, what Australian expats need to do before June 30. So tonight I'm joined by Pau Lam. Pau, we've become good friends over these webinars. You're from ODIN Mortgage and Tax. Pau leads ODIN's tax services division and has spent more than 10 years helping Australian expats and overseas investors navigate Australian tax, from strategic planning through to, like, I guess, prep. You probably, June 24, you're headed right into preparation and right into tax time. Because of that, we are 6 days out from the financial year. So we thought we'd put this on and make sure that we can really answer some of the crucial questions, some of the decisions that you need to make tonight based on what you might hear, because there have been some changes to the budget. And we want to make sure that you're across all of the things that you might need to connect with Pau about, or at least make sure that you've done a bit of planning and documented a few bits and pieces. You are, for everyone watching, you are muted. You can drop questions in the chat. I will be watching the chat and be trying to keep a bit of an eye on things. And we are recording this and broadcasting it to YouTube, and we have it available as a replay on our Moving to America podcast. So plenty of ways to listen. If you don't catch something properly, feel free to add a chat, but if you do really want to listen to the whole thing again, you can. Before we jump in and get started and I introduce Pau properly, I do want to throw up our disclaimer. The information in this presentation is provided for general informational purposes only and does not constitute financial advice, professional advice, or personal guidance. It is of a general nature and does not take into account your individual objectives, circumstances, or needs. You should not rely on this information as a substitute for obtaining specific financial or professional advice. Before making any decision or taking any action in relation to your particular circumstances, we strongly recommend that you seek advice from a qualified financial professional. Neither Pau, ODIN, Josh, nor America Josh accept any responsibility or liability for any loss arising from reliance on the information provided in this presentation. Pau, it's always the most fun part of of starting off one of these. We can give everyone a happier thing to think about, is that we're going to share a link. You've got a link in your email with a free budget impact assessment, which everyone has access to if you're watching tonight. But without further ado, Pau, thank you for joining me. I know, as I said, many people would have seen you before and we've met and done a whole bunch of different topics. But do you want to introduce yourself, what you do for ODIN, and really what ODIN Mortgage and Tax does for Australians and people abroad?
Yeah, thanks, Josh, for having me tonight. So, quick introduction about myself. I'm dialing you from Hong Kong, by the way. This is where we started our
Love it.
business. And as Josh mentioned, I lead the tax business here at Odin. I've been doing this over a decade since I left Sydney. Since then, been assisting Australians living abroad for their tax in Australia. Make sure you stay compliant and try to help you minimize your tax in Australia as well. What we do here at Odin, the target audience we serve is more the Australian expats living in Hong Kong, Singapore, UK, US, literally all around the world. That's what we assist. And our two mortgage main business arm is the mortgage and tax, which kind of surrounding with Australian property, mortgage, tax, in kind of the journey of holding assets back in Australia. How does it work, and how to help you mitigate that journey. And why we believe that we don't actually do too much of budget update every year, because sometimes the budget didn't talk too much about tax and have any changes every year. But I think this one we had back in May is substantially important because there are a couple of numbers changes that are related to tax and that affects expats as well. And hopefully in this section we can show you what that means in terms of someone living abroad, being a non-resident. What is the impact on us being an expat as well?
Okay, awesome. So, okay, let's jump right in. We saw, obviously, a lot of people watching tonight would have seen a whole bunch of headlines coming out when the budget came out, and I know I saw, social media lit up and there were all sorts of questions. Do you want to just start? I always like to start our expert Q&As 30,000 feet. What are the changes that really impact, like the 3 or 4 or 5 or whatever it is, the changes that really impact Australian expats? What changed?
Yeah. So I guess one thing what didn't change and is the tax residencies rules on us being non-resident. So we still apply the same rules. So we before we had some talks about changing their rule, but seems that didn't take any spotlight on this one. So what has actually changed is I put it maybe in like four things. One is the change in the trust. There will be a 30% minimum tax on the trust income going forward, starting from July 2028. There would also be some changes to negative gearing. Of course, we have some grandfather rules in place. The big one, I believe, that would impact expats is the capital gains change, which I can later show some examples, maybe in a good way or in a bad way. That could be still. That is a lot of these things we discussed tonight is still under legislation, so it's not really passed yet. So it's still ongoing with some of these debates and discussions, and just put in there that there could still be changes after the talk tonight. For sure, we would have to monitor. And then the last one would be kind of limited, aligned with the capital gains. There'll be a minimum 30% tax. So these are, I'll say, four major things that kind of affect expats for being someone living overseas and still may have some access back in Australia. These will be the major impacts.
Okay, so I guess what we saw was there were some real, these high impact changes to a lot of these structures. If you're an Australian resident, I imagine like there was some offsetting to like some tax cuts that took place that were meant to sort of say like, hey, look, we're taking here and giving here. But am I understanding right by saying that if you're a non-resident, if you're an expat living abroad, you get the, and I'm being kind of brutal here, but like you're getting the downside, but not the upside. Is that right?
Yes, I would say so. I would agree with the this budget. There wasn't too much of upside. It could be, again, it all depends on the legislations. There could also be upside on the capital gains, but so far on the proposal, it seems to be either neutral or slightly negative.
Okay. So we sort of talked about the four major things that you started with. So let's start with trusts because I do think there's a lot of people that might be watching here that have family trusts before they moved overseas, or they probably set up a bit of a structure. And I'm going to say things, and you can correct me if I'm wrong because I know that you understand this way better than I do. I've said that many times. But so the budget introduced a 30% minimum tax on discretionary trusts, right? So from 2028. So do you want to give us a bit of perspective? What does that mean? What? Yeah.
Yeah. So we have about a million trusts in Australia so far, and out of the million, there is about 800, which is a discretionary family trust, and this is the target group that the government is trying to look into. So the background was trust was widely used because of the ability that you can distribute income to different beneficiaries, and you can get equally reduce the tax payable compared to the breadwinner for the family who also have that income as well, and has been running pretty well for decades under this structure. But what they're trying to now cover is to introduce this 30% minimum income tax on the trust income. So that will be paid by the trustee, and it will be a non-refundable credit paid to the beneficiaries. So the beneficiary will not get any refund. They still need to look at our minimum 30% tax. So the impact on that is will start from July 2028. That after that, any income that the trust made will need to pay a minimum 30%. The impact for expats may not be huge for now if you are living overseas, because we pay tax on 30% anyway from first dollar. So if you distribute that income to yourself, you technically need to pay 30%. But it would impact you in a way of, oh, what if I distribute the income to my family members back in Australia? They are one of the beneficiaries. They could be, let's say, my parents who are retired. If I distribute 18,000 per head count to my mom, to my dad, they can pay nothing. But now the impact on them is, oh, they need to pay 30%. I think that was the main one that would get people in the future. And potentially, I'm not saying trust is no longer useful, it's less effective in a way of reducing tax. You could still enjoy the benefit from reducing from 45 to 30%, but it wouldn't be 45 to zero going forward. Josh, I think you're muted.
Yep, I tried to be savvy and turned off the microphone. Are there exemptions to that blanket rule for 30%?
Yeah, so again, we're only looking at the discretionary trust. So if you have anything in like a unit trust or other type of trust, they are not affected. And also with some of the other testamentary trusts, that's more for like under a will, those will not be affected as well. So we do have a bit of exemption on other type of trust, but mainly discretionary trust will be impacted.
Okay, and I've heard the term restructuring window has been sort of thrown around a lot. I tried to get savvy before we connected. So, what is that like? And sort of what is that window? What is the timeline? And what does that mean for people if they are sitting there? They do have a trust. What does this allow them to do?
Yeah. So again, government definitely realized that this is going to be impacting a lot of people, and they're now opening up a window for 3 years. That starting from July 2027 to 2030, you will be able to do some restructuring to what is in the trust. Let's say move out from the trust to bring back to your personal names, and the window, and they were giving some exemptions or rollover exemption in the way of to exempt from the capital gains. If you want to move from the trust back to your personal name, you can be exempt from the capital gains. They wouldn't see like a new transactions. They would be grandfather or roll over on the capital gains. But one thing worth to look into is it doesn't mean that you might be exempt from the stamp duty, because that's more like a state government decisions. Whether the state government would say, oh yes, we want to work with the government and to keep the exemption on the stamp duty as well. So putting example, if you already have a property in a trust, because of the impact now, you want to move it out from the trust back to your personal name, you might be fine on the capital gains because of this 3-year window to do it, but you might still be subject to capital gain, the stamp duty. So there are still, again, and still under legislation, we still need to monitor what is final in the term, but that at least give you a window to do something about it.
Okay, so seeing that, just to recap on that whole, like, it hasn't actually been locked in. They're still debating. Do we have a timeline? Is there any idea of when we will firmly know what the rules are? I guess some of these things aren't changing for another until 2027, so it doesn't really impact us now either way. But do we know, like, will we have it firmly in line soon?
Yeah. So right now it's at the Senate for discussion. So what, based on earlier the week, what came out on the news is that the Greens has now agreed and they made a deal with the government. They will be supporting on the reform on this couple of things we discussed.
Yep.
But still under debates. The earliest probably we will find out is early July, because that's the window the parliament will close. So we might be able to find out in early July on the updates on whether it will pass the Senate, and if so, then they would pass on to the royal consent, and that become laws after. So I think it's more on the legislation being discussed, and that could still be changes, I believe, because we already see some changes since May to now. The government already see some backlash, but they also trying to make things work as well. I think we just need to monitor for the next 1 to 2 weeks.
Okay, so if you are holding onto a trust, is sort of the advice to start, like, have a plan for if it passes and have a plan for if it doesn't? Is that kind of how you're structuring your discussions with your clients, or?
Yeah, for trust for now, again, we can wait because you still have the 3-year window starting
Sure.
from July 2027 anyway. So I would recommend just to monitor the change and what comes down in the final legislations. If really they're going to impose the 30% minimum tax, then that might open up the conversation that, oh, do I then want to start looking into moving some of the assets to other structure, company, personal names, or other type of trusts.
Okay, so that was our first bundle, 30% trusts. Still obviously finalizing that, but so there is a possibility that you might need to restructure or talk about the financial plan for if that's going to hit you. The big one that I think most people, or at least my Facebook was lit up with, was negative gearing. There was a lot of very scary headlines and all sorts of information throwing around. Do you want to explain, like, who is affected by the changes to negative gearing? Let's again start as zoomed out as possible, and then we can go from there.
Yeah. So on a greater scheme, that the impact is that people no longer able to use the losses to offset the employment income. But we do have some
That's negative
grandfather
gearing in a
rules.
box, right? Like losses
Exactly.
on
Yeah.
a property to offset
Yeah.
against profit,
Their salary
salary tax. Yep. Okay.
yeah, and get a refund. So that's the most common way people why want to invest in a property, because they can utilize and get money back and then use that money earlier. But now
Yep.
the change is they're gonna kind of put a stop to it. But they do have the grandfather rules as well, that if you already have a property that was negatively geared before the budget night, May of 12th, you would be exempt. You can still enjoy the rule until the property maybe become positively geared. But it's worth to note that again, this just an update came out I think 2 days ago. There might be some changes to that. If you own this property with someone else, like you and your partner, and one of you pass away or we go into a divorce, that will break the rule. That will break the grandfather rule. So,
Oh wow.
like I said, there could be changes coming every day. So we still need to wait until the final legislations. So that was the grandfather on existing properties before the budget night. And after that, the change would then happen that if you are looking to buy second-hand property, you no longer able to use that losses to offset the employment. That's how they take it away from you. But it doesn't mean that that losses is gone forever. You can still use that losses to offset the future rental income or property capital gains. So it's just a way of using that losses now will change to
It's not
only
not
related
income
back to
tax,
property.
but got it.
Exactly.
Okay, so it
Yeah.
puts property in sort of its own bundle. But
Yeah.
so for the
And
grandfather rule. Oh, sorry, please.
yeah, just one more thing is the or you if you're looking to buy new off the plan property, you would be able to still enjoy the negative gearing. So I think that's the solution the government try to come up with, is to try to create more supplies to solve the housing problem in Australia, to encourage the developer to be more new builds, and maybe the investor will look into purchasing the new properties, and you will be able to still enjoy the full negative gearing.
Got it. Okay. So the grandfather rule in and of itself is sort of saying, like, if I bought a property some years ago, before like 2019, like, and I've had that for the period, nothing changes for me. Like, this budget did not change anything for me if negative gearing, assuming that, like, the ownership with my partner didn't change. We know, I know that's a pending rule. We don't know about that discussion. But if it's owned by the same people and I've held it for 10 years, I could still keep negative gearing in exactly the same fashion.
Yeah. So no change to that. The property you bought in 2019, you can still accumulate these losses.
Yep.
I think the difference is that we don't earn an Australian income for now, so there's no other way we can use it for now. But these losses can be carried forward to future. Let's say, Josh, you come back next year, okay, in Australia, earning employment, and that's a window. It would open up for you to apply these losses to offset.
Okay, so and you can accrue them. Can you accrue them forever? Like, while
It's
you're away?
indefinite, yeah,
Wow.
indefinite
Okay.
until that, to the point that either you break the rule or you start to utilize these losses to offset the employment income in Australia.
Okay, so for the period of people, so if you are living abroad, so the people watching today, and they've owned a house for a while, they are currently doing this. They're accruing, like, losses. If there are losses on the property, they're accruing that refund. They can't use it because they're not paying, or they're not a tax resident in Australia. They move back to Australia. They can then apply that. So yeah, okay. I'm explaining negative gearing, but it helps, I feel like.
Yeah.
But yes,
So
broadly,
that
yeah.
so that's I would say the impact on expats, this change in expats is not that huge,
Yep.
given we don't earn any Australian income for now, and we have the grandfather rules in place. But it would impact the decision, I guess, going forward on making a purchase in the future, or the market itself. That people in Australia, they might lose the incentive to purchase a second-hand property. That's a more impact on the property market itself.
Okay. And what about for, like, again, these transitional windows? Like, if you've uh, since budget night, like, you've between now and 2027, like, obviously we're still in that sort of limbo stage at the moment. Do we have, like, a firm idea of what would happen if you did buy a property now?
Yeah, so any property you buy after, if you bought it before the budget, like I said, grandfather, no issues. If
Yep.
you bought after you signed a contract, 13th of May, after the budget night, then you still have until July 2027 to, for like almost 1 year, to apply the exemption, the negative gearings. But after July 2027, that's when any losses you make cannot be used to offset the employment income anymore.
And does the grandfathering rule Like, what's the grandfathering rule date? So if I bought a property
That will
now,
be
do I
forever.
get? Oh, right. Okay. So
Yeah,
I do that. I
the
get that. So if I
any
buy, got it. Yeah.
yeah, any property you bought before the budget, again, you already held before the budget, that will be forever grandfather,
Yeah.
until again either you break the rule or the property becomes positive.
Okay. And like positive gearing, neutral gearing, like this is that's all sort of nothing's changed in terms of tax structures for those.
Yep, exactly. No change to those.
Okay. I know we had one question come in about offset accounts, like and sort of just setup of how like they've got their finances arranged. Does anything change with the budget for that kind of setup?
You might want to. I think the change would become that. Oh, do I want to keep the negative gearing benefit for as long as I can? So in the way of, or I know that I will lose it once I pay down my mortgage. Then do I want to, rather than pay off the mortgage by utilizing the offset account to put some money in the offset account, so at least I'm not directly paying down the mortgage. I can take the money out from the offset account. That's when I start to pay the interest and bring myself back to the negative gearing positions.
Okay.
It will give you the window that, at least the flexibility that you can do with the offset. Whether I want to, maybe the interest rate is a bit high for now, I would drop the interest rate by putting the money in the offset. But when the interest rate comes down, maybe next year, then you might want to reassess that position. Is it the best option still to leave the money there?
Okay. Um, so I guess broadly, just to sort of recap all the things we've talked about, if you are in looking to invest, it looks like possibly investing in a new property, like a new build, would have long-term benefits, but investing in an established property that already exists, the economics have kind of changed for people living abroad.
Exactly. So if you are an expat, you don't have a plan to go back to Australia, maybe the impact wasn't that huge. Like I said, if you're
Sure.
not expecting to earn an Australian income, you might not care about this because you won't be used it anyway. But if you have a plan to come back to Australia in a few years, that might be an incentive to look into the new builds, that you can still apply these losses. So when you come back to Australia, the losses can be used up to your first year of income. You get a full refund on the PAYG withholding, and that strategy will be way better than buying second-hand properties.
Okay. So we've done trusts, we've done negative gearing. Pillar number three, capital gains. So the 50% capital gains discount has been around for years, 20, 30
Yep.
years. As of the 1st of July 2027, it's going away. Do you want to explain just broadly? I just always like quick in a box, like what capital gains, what the discount was doing, and then what that means for people living overseas if they've got property or shares, yeah, from us doing that from overseas.
Yeah. So one quick thing before, is that we already lose that 50% discount as a non-resident, since 2012. So back then in 2012, the budget already removed that rule from us as a non-resident of Australia. So they kind of just want to impose the same to the greater 27, 28 million people in Australia. And they're going to replace it with the indexation method, which is inflation. So, to put it in simple word, is you would not get a flat 50% discount. We're talking about those living in Australia. What you would get is a replacement of the inflation. So if we're talking about 3-4% inflation a year, it might then take you a longer time to catch up to the 50%. So that's the major impact. Again, we don't see the impact so far for expats because we don't get it anyway, but there could be, and this will come in from July 2027. After July 2027, you might not able to enjoy as well. So that would be like a best case scenario and worst case scenario based on, again, what the final legislation says. So the best case scenario is that we, being an expat, we are able to enjoy the indexation. So compared to now, we get no discount at all. We may be able to get some sort of inflation to be taken into account after July 2027. Or the worst case scenario is that we don't get the indexation method at all. And even worse is, if for now you're living overseas, maybe no change to you, but when you decide to come back to Australia, supposedly you should be able to get the indexations. The most extreme case that could happen is you might not able to enjoy indexation even when you're living back in Australia, because they might impose a all or nothing rule. If you ever been living overseas after July 2027 as a non-resident, you would no longer get the indexation at all on that property. And that is what currently being put into the proposal. And again, like I said, there could be a lot of changes coming. We still need to monitor what happens to these rules. If that really happens, then yes, it does impact on existing expats on their existing assets in Australia, and it could also impact the future decisions of investing back in Australia as well.
Right. Okay. Wow. So best case scenario. And I know I'm just going to recap this, but so right now, if you are living abroad, you get 0% because we don't get the 50% reduction in capital gains, as if when you were living in Australia, you'd get a 50% discount on capital gains.
Yeah,
The rule change means that if you were living in Australia, so let's pretend we're all living in Australia, the 50% goes away and they're doing an indexation. So based on inflation, they are giving you a discount that would change. So we'll talk about how much it is in a second, but you'd get some sort of discount. It might not be as good as a 50% discount, but it will be some sort of discount. So, and then but then we've got the people living abroad. So they weren't getting the 50%. The best case scenario is that this new rule would say it's a blanket rule for everyone. Everyone gets an indexed discount, which would mean for if you're living overseas, that could be fantastic because it could mean that suddenly you're getting a big discount on capital gains. The worst case scenario is that we don't get that, which would mean we're kind of just net out. Also, the middle ground is that we neutral and we just don't get a discount, which sucks, but we didn't get one anyway.
yeah,
But then this worst case scenario, so the current reading of the legislation says that if you have ever been non-resident, ever, you don't get it. And when you go become resident again, you still can never access the indexed discount. Did I just
that's
summarize
right.
that
Yeah,
right? Okay.
that is 100% correct. So this is what
Jeez.
we then later find out that, oh, like 'cause they didn't put the final terms on the budget night. Later they release an update, and that's what they put into the legislation proposal at least. And this is what being discussed still in the Senate. So we still need to look into what happens after that. And I think this is the most extreme cases, and hopefully the government realize this is not working for expats, and maybe at least turn back to the neutral position that for now maybe you don't get it as an expat, but when you come back
Sure.
to Australia you would get the indexations again. If that happens, then I would say this capital gains rule change is neutral, no huge impact to our current position.
It sucks now,
But
sucks later.
exactly
Yeah.
the same thing. Or the worst, the best case is we hope that they would apply that and impose that to us as well, being a non-residents. Again, we should find out in the next 2 weeks.
Okay. Do you want to explain, just because I don't actually know what I've been saying indexation, but what is cost-based indexation? Like how does it
Yeah.
work? What?
So let me give an example. So because this will come in July, 1st of July, 2027. So
Yep.
let's say your property is worth $1 million in July 2027. And inflation, for example, inflation for last 10 years was around 34% in Australia. So, and assuming you're gonna hold the property for another 10 years, you probably will get something similar, like 30% inflations for the next 10 years. So that means your cost base is not 1 million. Your cost base is 1 million times 30%. So then you would increase your cost base, which means you make less profit, real profit. And when you calculate your capital gains calculation, you would pay less tax from that regards. If again, the indexation applies on us. And we also have another change, which is the 30% capital gains tax as well, minimum 30% capital gains tax. Again, that impact is much smaller on us. As I mentioned before, we already pay tax on first dollar at 30% as a non-residents. So the impact on that is literally the same, that we pay 30% anyway. But it would impact you in the future when you come back to Australia, because there could still be a scenario that if I'm not working, I sell some of the assets and make some capital gains, I could be earning below the $18,000 threshold. I should be paying nothing. But now they're just saying that, oh, if this comes from a capital gains event, you make $10,000, you still need to make $3,000 tax to the government. So that's more impact in the future when you come back to Australia.
Okay. Got it. Oof. Sorry. So would the indexation ever be like more than the 50% discount?
It could be. Again, when I look at the past history, last around 15 years, the index inflation was around 50%.
Okay.
So imagine that you behold the property for another 15 years or 20 years, and inflation is kind of the same to what happened in the past. You could also get more than 50% in inflation as well. There's no cap on it. So it could be higher than 50%. But that just means that you need to hold the property for longer. It wouldn't be like, oh, let me hold the property for 2 or 3
Got it.
years and
Yeah.
make some decent profit and apply the 50% discount. You might need to hold it for like 15 to able to get back to the 15% level.
Got it. Okay. Let's say, because we're talking about sort of wiping out like I think what a lot of people would have sort of said, I'm going to go back to Australia, get my discount. Like that's sort of part of my plan. So if I've held a property or I've held something for 15, an asset for say 15, 20 years, would that like discount, if that goes away, like if I was, and again, this applies to people in Australia, do I lose that with this new rule as of like the second they stamped that, it's just like the discount just went away and all that value that you've gained that you kind of assumed I was going to save 50% on, that's gone? Or is there a time, again, is there a transitional window? I think I've said that now
Yeah.
3 times.
Yeah. Yeah, we do. So what happened is we still, because the cutoff is 1st of July next year, 2027.
Okay.
So the government will look at two calculations. One is any profit you make before 1st of July 2027. That's when we will still apply the existing rules. If you, for
Got
some
it.
of time, maybe you were living in Australia, you can still apply the 50% discount. For the time you were living in the state, you don't get it. So it's still like a pro rata calculation.
Okay.
But in anything after July 2027, would then be looking into whether you get the indexation or not.
Okay. So you'd still keep, like it is sort of calculated pro rata, even post July 2027, you'd still get for up to that period, you'd still get the 50%. And then post it works, it's the whole like positive, it's the whole, like depending on the scenario, we don't really know.
Correct.
Yeah.
Yeah.
Okay. And how does this interact with like the main residence exemption that I think a few years ago, like non-residents lost the ability to have sort of a main residence allocation? How does this interact or stack on top of that?
Yeah. So this budget didn't change anything about the main residence. So then for people in Australia, when they sell the family home, they still pay no capital gains on the property. And for us, because we already kind of lose that rule since 2020, that means that, well, I wouldn't say completely lose it, but it just means that you should not sell when you're living overseas. You can still get the rule applied when you sell it when you come back to Australia. So it's just a window timing. That when do I sell? When do I not sell? That rule didn't change. You can still get the exemption if you come back to Australia and sell your family home when you were living there for the past. You will still be able to get the exemptions. And the key advice here is if you do have a family home that you have been living in the past, maybe that would be the last one you want to look into in terms of selling. You might want to look into if I need the money, I might be looking to selling the existing investment properties first before I touch that last one.
Okay. So I guess realistically, like what the question that I'm sure a lot of people are thinking about is, am I on a timeline where I need to be thinking about selling assets before July 1, 2027? Is that something
Yeah.
that I guess somebody comes to you and says like, here's my position, and you can kind of lay out like, if this happens, then this happened. Like, is that sort of how it works? Is it a real conditional thing, or yeah?
No, I wouldn't say it's a need or a must to sell before 1st of July 2027 because we do have that grandfather on the
Right.
capital gains
Sorry.
we made
Yeah.
so
Yeah.
far. Yeah, so no change to what happened or what gains we make so far, and we still apply the existing rules. It's more the future after July, what happens after. So it wouldn't be a decision that I must sell it, otherwise I will lose some of the benefits. It's more on the market itself, whether it's a good timing to sell? Do you see some benefit to sell now? And it could be have that right now it's a bit softened the market because again a lot of people are waiting to see the final legislation, so people are
Sure.
not taking any action. So maybe not a good window to sell, but you are not in a position that you need to force yourself to sell anyway. So that one is more the market. What do you believe in the market itself?
Got it. And is there any differentiation between like for capital gains around like new builds and investment, like sorry, and yeah, new versus old? I know that we were talking about that
Yeah.
with our previous topic,
Y- Yes.
negative gearing.
So
Yeah.
yeah, this is what another benefit they try to put on new builds, which is you would so we're talking about any property you purchase after July 2027 or now, you still get the current exemption until July when the rule change. But if you're looking to buy new builds, you will be able to have election between the two methods, whether the 50% discount or the new indexation method. So let's say the worst case scenario, we would not get the indexation at all. And even
Yep.
when you come back to Australia, you won't get it as well on existing properties. Then maybe your strategy will shift to, let me look into buying the new builds, because
Okay.
the new build I can still choose the 50% capital gains discount method. So that means if I do come back to Australia, I can go with the 50% discount still.
Got it. Okay. So there, yeah, so much of this is so up in the air. But there is a strategy where a new one might be like for investments. Yeah, you might be considering how to do that
Yeah.
instead of buying. Okay, instead of buying an established place. Is there any knowledge like that you have around inheriting? I know we had a few questions around inheriting property and inheriting assets and how that interacts with all of this and are these changes?
Yeah. So again, no change to the inheritance tax in this budget. So in Australia, we do not have any inheritance tax. So at the time when we get a property from maybe our parents, we don't pay anything at the time of taking over the property, but we do inherit their tax liability. So let's say you get a family home from your parents and also another investment properties. On the family home, because they live there, so you won't pay any capital gains for the time when they were living in the property. If you do decide to keep the property, then that's maybe the capital gains will come in from the date that you take over the property. For investment property, because it was still a liability or capital gains liability for your parents, so you will still carry on their liability. So still, when you come to selling the property, we need to look at how much did your parent bought it for, and we look at the original purchase price to now. So again, the decision is you don't need to sell if you got any inherit property. It's more the impact on the future or after July 2027. That's when you may not get, depends on legislation. You might or you may not get any indexations.
Got it. Okay. I know we've got a few questions that I want to answer from people who registered, but before we get there, I feel it's always crucial. Like when we talk about this, we still, and I noticed in the questions, we still got some confusion around tax residency and just what's happening with the end of financial year fast approaching. Do you want to just quickly like summarize for the people living in the US and tuning in how tax residency works, like whether living overseas is the equivalent to tax residency? Just give us a bit of a big picture because I think that might help just to make sure we've absolutely covered the essentials
Yeah,
that we're talking about here.
this could be a topic I can speak for like hours. So I try to keep it short.
Settle in, everyone. I'm
Yeah, so good thing is we didn't have any change to the residencies rule, so we still
Yep.
use the rules that we've been using for decades, which is the 183 days test, the reside test, the domicile test, the Commonwealth Super. So quickly on last point, if you are not working for the Commonwealth government, you should be fine. You won't be treated as like a tax resident of Australia.
Yep.
So then we look into how often you come back to Australia. Are you truly living overseas? Do you have a domicile overseas? Is the family with you overseas? Your job, etc. So I would say for most of the Australian expats we've been assisting, most of them are non-resident of Australia because they live overseas. And I would love to use the number of three. If you have been living overseas for more than 3 years, or have
Yep.
an intention to be living overseas for more than 3 years, and literally your life happens overseas, that is quite safe to say you are a
You are.
non-resident of
Yep.
Australia. So
Okay.
that means that whatever you make in the state doesn't need to be reported in Australia. It's quite separate. You only need to look into the income you have in Australia, a bit of interest income here and there, maybe the rental income. Those are the ones that we then report to the government.
Okay. Cool. So it is there's the 183-day test, but there's also like fuzzier, I guess, ways that they interpret it. So it really does come down
Yeah.
to like intent and like if you've got like if you would tell people I live overseas, like that kind of does come into it, right?
Correct. Yeah, the actions you actually been demonstrating, are you truly living abroad in
Okay.
in a country that like for long term?
Okay. And with the end of financial year, like is June 30, so EOFYs, I'm sure that's still stuck in my head from years of commercials. Is there like a residency requirement? Like, do you need to do anything heading into like the end of financial year to make sure you're not triggering anything? Or
Yeah, I would say this is something you should talk to your accountant every year to just assess and confirm the status, your tax business status.
yep,
What happened to myself? Am I living overseas? Am I doing the things that kind of trigger the non-resident status? Or if anything changed that I actually been moving back to Australia or my family moved back to Australia, that could also be a scenario that you still live in the state, but then your family, because of schooling, that could be one of the major reasons that they have to come back to Australia. You're kind of creating two different households. So those are the cases that ATA will look closer. So that's what you might want to get a confirmation on the status. I would say to confirm to make sure that okay, you're not falling into any traps to be treated as a tax resident. So then your income in the state will now need to be reported to the tax office.
okay. So and on that for so if you're earning money like rent or dividends from Australia, is that what triggers in general? And there's obviously exceptions and all sorts of things, but like in general, on whether you have to file an Australian return.
Yeah. So even though you might not have income, if you do have income, for sure you should submit a return because
Okay,
that's your
so
obligations.
yes, if you have income in
And
Australia, you need to file a return in Australia.
exactly, yeah.
Yep.
But for those that who might not have income for now, you still want to do it for a couple of reasons. One, to avoid a late submission penalty, because right now we're talking about 1,650 Australian dollar per year
Woof.
for late submission. Second one is for compliance to make sure that the government know that in Australia, the tax office know that you have been living overseas as a non-resident. So whatever income you make in the state is not related to them. You want to protect yourself from the grab from the tax office, which can be a simple action every year to tell them that I'm still a non-resident. I just don't have any income in Australia, and that's why I want to give you the status update.
Okay, cool. And we did have one question. I'm sorry, I'm bringing it up. If you have non-resident withholding tax taken out of your like savings account in Australia, do you need to file returns? Does that count as?
Yeah, in that case, if the withholding tax has been taken out correctly, you
Yep.
don't need to report that income again. But again, you still need to give the notice to kind of put a stamp to your record for the year, and
Okay.
also to let this that's to avoid the late submission penalty, and also to let the government know that yes, I have still living overseas, being a non-resident of Australia. So
Okay.
that's a two separate thing. One for compliance, one for the income reporting, which the income reporting may not be the issue, but the compliance issue is something you still want to look into.
Got it. Okay. So a lot of the times, like I guess there's a practical method that is not necessarily required, but like just in case, it's sort of easier to file like a zero like report or file like the sort of the little bits and pieces, just because that way you are absolutely not triggering something for the ATO to find you on. Is that kind of like sometimes it's just safer and easier?
Correct. Yeah, we do come across someone with no income in Australia, then those are like a really easy process every year. Just
Sure.
a few buttons to click and update the tax office on the
Yep.
status.
Okay. What about part year? Like, if people have lived part year in one country, part year in another country, like they've moved halfway through the financial year, for Australia's purposes, how does that is that done on like a pro rata basis again, and it's sort of worked out day by day, or how do they do that?
Yeah. So yeah, we do look at the cutoff, whether you left Australia to move overseas to the state, or you're now leaving the state back to Australia. We then look at this. This is the crucial financial year. You'll be treated like a partial resident and partial non-resident, and it's important then to tell the government, the tax office, that oh, when do I leave Australia or return to Australia? When did that status change? And anything that you earn before, let's say it's a scenario that I want to come back to Australia, so important to tell them that, or when do I come back, and anything I made in the state before that date is not taxable in Australia. So I would only be looking into, oh, today is 25th of June, I come back to Australia, do I still receive any income from overseas? If not, I don't need to report anything from abroad. If I still receive a bit of interest overseas in a US bank account, for sure I'll report those. And we do have a double tax agreement in place between US and Australia, but that's more another topic, I guess. But in simple rules, like you won't be taxed twice.
Okay, got it. Okay, so it's June 24. I keep saying, we're flying into the end of the financial year. If you were sitting there and someone's thinking, like, I need to sort some things out, is there a sort of checklist, or is there any things that people should be like, hey, I mean, I realize, like, ideally you go chat to Pau and chat to the team at Odin and chat to your accountant and sort of get your house in order. But are there sort of a few things that people should write down and say, like, hey, have a look at this?
Yeah. One I would definitely do is, again, every year should review the tax status, the residency status, to make sure, do I still qualify being a non-resident? Did I do anything that might trigger, especially like I spend a bit more time this year in Australia, and why was that? So that's the one I would check every year to ensure the status, the residency status didn't change. And then the others will be more on the income side. That do I receive any income from interest, from dividend, from rental, whether the withholding tax has been taken out. If yes, maybe I don't need to report that income anymore. If it didn't happen, then for sure I need to make sure I include those into the return. Otherwise, there could be because right now technology is so good. There are a lot of data matching software ATO has been using. So it's just a matter of when they find out that you have income that you haven't report in the return.
Got it. So I guess to answer we had a submission around, like, is it too late to think about it? Putting your head in the sand is never the solution. Like, if it's always worth asking the question, like trying to get to the bottom of things, and then at the very least, like filing something, because that's better than just sort of hoping that they don't find out.
Yeah. And just share a quick the live case we help. There was an expat we assist to kind of file 25 years of backlog tax returns in one go.
Whoa.
They left in Australia in 2000, and that happened last year. They left in 2000. It kind of makes sense because information maybe not that transparent back then and that useful. So they thought that, because I'm living overseas, I may not need to report anymore in Australia, but they do have income in Australia because they thought that, I get the $18,000 threshold, which wasn't the case. So they kind of wasn't fully aware of the rules, and only when they come across and know about us, then we help them to look deeper into it and realize you've been late for 25 years, you have income, you need to. But lucky was the property was negatively geared. So at the end of the day, they didn't pay too much of tax. It's just more compliance to protect their overseas income on their status being a non-resident.
No, it's good to know. Yeah, that terrifies me, and I'm going to put my head in the sand. So, okay, a couple of questions that came through. Does this affect me on like a temporary visa? Like, I guess my question to you, Pau, would be, does visa status and stuff matter, or is it really just down to like tax residency? That's really the fundamental important part.
That is one of the factor. Yes, visa could matter in some case if your other action didn't strongly like demonstrate you have been living overseas, and
Got
that's
it.
what one of the factors the tax office will look into. Or do you have a job? What visa are you on? Is it like more like a temporary, or they give you like a couple of years that you can stay overseas? I would say it depends on the type of visa you're holding. If it's a normal E3, then this should be fine.
Okay. If you bought an investment property in 2019, are you grandfathered into all of the changes? So I guess to quickly re-summarize, like for negative gearing, like, yeah, you are,
Yeah,
right?
yeah,
Yep.
correct.
And then for capital
And
gains,
that would happen until July 2027. So
yep,
until any profit you make until July 2027, we
it's
still
covered.
apply the current rule, and then
Yep.
only the new rule will then kick in after that.
Cool. Should I sell my property before the 1st of July 2027? So I think I asked this as an example. What do you say? Like, is it sort of
Yeah,
case by case is
I
kind of the
would.
answer, I guess?
Yeah, I'll say case by case. One is they definitely no urgency in terms of I must sell before 1st of July, otherwise I would suffer from that.
Yep.
It's more a decision to the market, to your financial positions, whether this might be a good window to sell, and I guess your sentiment on the market itself. But be expected. over the next maybe like 6 months, and maybe the market will be a bit softened because of a lot of uncertainties. But in general, I do believe that the property market in Australia is kind of healthy. So it's more
Yep.
like personal decision.
Okay. Are family trusts still worth having generally? Like,
Yeah, I just spoke with another expats. They do have a family trust. They set up when they were in Australia. Now they've been living overseas. I would say if you so far have no plan to come back to Australia and that trust is not holding anything, then maybe you can look into closing it down, given you're not utilizing it fully, but you already been holding some access into it. It's still worth. It's just that it's less tax efficient compared to in the past. That in the best case scenario, you can reduce from 45% tax to zero, but now it's more like 45% to 30. You still see some upside that you can save like up to 15%, but it wouldn't be like a huge math in like in the past, 45% benefits.
got it. I know we haven't touched on self-managed super funds. It's a whole kettle of fish, whole can of worms, kettle of fish. Not for, but like this, it's something that people can talk to you about, I imagine.
Yeah, something we can look into. And just one thing quickly, maybe they do. This came up on yesterday. That in the future they will be limiting or abolishing the self-managed super fund lending to like trying to buy a property, use a self-managed super fund. You will not be able to get lending anymore. So I do think the government also try to look into self-managed super fund. So it's getting more difficult to manage, but something, yeah, we can help this look into.
Okay. And similarly, that's a little bit out of scope for tonight, but something just to flag. How, like the interaction with, and you spoke about this a little bit before about no, there's no double taxation, but the interaction with US taxes, is that something that like people sort of come to you and you bring on someone in the US and you sort of build a whole package of
Yeah.
understanding how it all fits together?
Yeah, correct. So again, we specialize in Australian tax, so we are
Yep.
so good at what we know about. But when it comes to US, again, that's not a battlefield we want to be in. But we do work with partners in that space that are, who specialize in helping the Aussie expats in the US to look into the US side. In general, in Australia, they don't care too much about what you have in the state for now, being a non-resident. It's more that of what now, because you live in the state, you might need to report some of your income from Australia into the US, and that's not something you can talk to the local accountants that you have in the states.
Okay, cool. Pau Lam, we've gone through like the four major parts of what's changed in the budget. I think it's like a fantastic summary because I think a lot of people, when we saw all the headlines come out, it was confusing. There was a lot of misinformation, and it obviously comes thick and fast. So, thank you very much for like coming today and really starting to summarize things. I know. Do you want to explain? I'm putting on the screen now. There is a link that ODIN does provide all of America Josh's community, which is an assessment call. Do you want to quickly explain just what that is and what it can be done in
Yeah.
between now and?
Yeah, sure. So again, to thanks Josh for having us tonight. We're happy to give back to the community that if you have any questions, you are not sure about your residencies, about the budget change, how does this one impact yourself? Because we've been talking on high level, general info. So this assessment meeting will give you the opportunity to talk to our team to either look into how we can help you on the tax side, any changes that would impact your personal holdings or access in Australia. It's more for the advising piece, and this is what we've been trying to say. This is more for general information. If for your personal one-on-one section, this is exactly the spots that you can do and bring it up front to us, and we can look into and give you the tax advice, true tax advice, personalized tax advice on this call.
Okay, awesome. Pau Lam from ODIN Mortgage and Tax. This is fantastic. For everyone watching, I want you to make sure that you like and subscribe on YouTube. I've never said that before. That was really weird. But we are on YouTube at America Josh, and we do have a podcast that this streams to, and all of our expert Q&As go straight to that, which is called Moving to America. It's a nice photo of me on the cover. It's available on Apple Podcasts and wherever you find good podcasts, and Spotify and all the good places. I would love it if you can follow. We do have some fantastic experts like Pau. Pau and I have now chatted, I think, 4 or 5 times about different aspects of tax and how it interacts. And when things change, we've done emergency ones, we've done quick ones, we do these hour-long ones when we've got a little bit more to really dig into. But it is sincerely appreciated that you come on here and really try and just give people a bit of insight, because I think it puts minds at ease and it gives people someone to grapple into and start their quest to make sure they get it right. So Pau from ODIN Mortgage Tax, thank you very much. And thank you for the assessment calls. I think people should jump on that before June 30. It is June 24, so click the link as soon as you can. And yeah, just at least put your mind at ease. So thank you very much, everyone. Thanks, Pau, and I'll see you next time.
All right. Thank you, Josh, for having me.